Hey there. Ever listen to financial news and feel like you've stumbled into a conversation in a completely different language? You are not alone. Well, today we're going to crack that code. We're going to break down all that essential lingo that traders throw around every single day.
Seriously, it's a great question. Why are there animals in the stock market? You hear about bulls and bears, and you're probably thinking, did I accidentally turn on Animal Planet? It sounds kind of weird, I know. But trust me, it's all part of this secret language, and I promise by the time we're done here, it's all going to make perfect sense.
All right, so let's get into it. The easiest way to think about all this trading talk, it's like a secret handshake. Seriously, once you know it, you're in. You get what's being said, you understand why things are moving, and this right here, this is your official invitation to learn that handshake. Okay, first things first. Before we get into any of the complicated stuff, let's start with the most basic, most fundamental piece of any trade, and it's this. Which way do you think the price is going to go? Up or down? That's it. It's that simple. Every single trade starts with that one question.
And that question brings us to our first two really important terms, long and short. So, when you hear a trader say they're going long, all they mean is that they're buying something expecting the price to go up. Super simple, right? You buy a stock at, say, 10 bucks, it goes up to 20, you just made money. That's going long.
But what if you think the price is going to go down? This is where it gets interesting. This is called shorting. Now, this can feel a little backwards at first, so let's just walk through it together step by step. It sounds way more complicated than it is. First, you borrow shares of a stock from your broker. Then, you immediately sell those borrowed shares at today's price. Let's say it's high. Now you wait. If you're right and the price drops, you buy the exact same number of shares back, but now they're cheaper. You return the shares you borrowed, and that price difference, that's your profit. The key thing to remember is this. Shorting is how you bet on the price going down.
And look at that, we're back to the animals. See, I told you it would make sense. Bull and bear are really just fun ways to talk about that market direction we just covered. So, if you're bullish, you think things are going up. You're feeling optimistic, like a bull charging forward. You're thinking about going long. And if you're bearish, well, you expect things to go down. You're a bit more pessimistic, and you might be thinking about shorting.
Okay, here's a little trick for you. This is the absolute best way to remember this, and you'll never forget it. Think about how these animals attack. A bull, it thrusts its horns up. A bear, it swipes its claws down. So a bull market goes up, and a bear market goes down. Simple, right? It just sticks in your head.
Okay, so we've got our direction figured out. Up or down, bull or bear. But now, what price are we actually paying? Because it's actually not just one single number. For any given stop at any given time, there are really two prices you need to know about. First up is the bid price. The easiest way to think about this is like an auction. The bid is simply the highest price that any buyer out there is willing to pay for a stock right now. This is all about what people are willing to pay. It's the demand. And on the flip side, you've got the ask price. This is the lowest price that any seller is willing to accept to sell their shares. This is the supply side of things. So you've got the buyers over here bidding and the sellers over here asking. So what about that little gap in the middle? You know, if buyers are bidding $10, but sellers are asking for $10.05, what's up with that 5-cent difference? That space isn't just nothing. It's actually a really important part of how all this works.
That gap, that's called the spread. It's just the difference between the bid and the ask. And you can pretty much think of it as the built-in cost of doing business in the market. Now, you generally want to see a small or tight spread. Why? Because it means there's a ton of buying and selling happening. It's a healthy market, and it means it costs you less to get in and out of a trade.
All right, quick recap. We know our direction, long or short. We get the price, bid, ask, and that spread in the middle. So, how do we actually do something? How do we tell our broker, hey, I want to buy this? Well, that's where order types come in. These are basically your instructions to the market. Now, there are a bunch of fancy order types out there, but they pretty much all boil down to these four main ones. A market order is just you yelling, get me in now, I don't care about the exact price. A limit order is more specific. You're saying, I only want to buy at this price or better. A stop order is a way to get into a trade if the price starts moving in a certain direction. And then there's the stop loss, which is your escape hatch to get out of a trade. So the real difference here, the thing you need to think about, is the trade-off. With a market order, you're in, instantly, guaranteed, but you might not get the best price. With a limit order, you get to control your price completely, but the market might never get to your price, and you could just miss the whole move. It's a choice between speed and price.
Okay, listen up. Because of all these orders, I'd argue the stop loss is the single most important one. Seriously, especially when you're starting out. The other orders get you into a trade. This one gets you out. It's your safety parachute. Before you even enter a trade, you decide the absolute maximum you're willing to lose. You set your stop loss there, and if things go south, you're out automatically. It's how you protect yourself.
All right, let's just take a breath and look at everything we just covered. In just the last few minutes, you've gone from maybe feeling totally lost to having a really solid toolkit of the most important trading terms out there.
So here it is. This is your new secret handshake. You now know what it means to go long or short. You get the difference between a bull and a bear. You understand the bid, the ask, and the spread. And you know the main ways to actually place a trade. This is the language of the market. And now you speak it. So now you've got the vocabulary. You're equipped to actually understand what all those people on TV and online are talking about. The next time you listen in, you're going to see it completely differently. So my question for you is, now that you're in on the secret, what are you going to listen for first?